Charter member exclusive event tonight. I'm really excited about this topic as we've all been hearing about SPACs in the news quite a bit, and most recently some interesting updates from the SEC. Yes, just as early as yesterday, looking into these. It's been an interesting topic in our region, especially with a few companies in our region taking the route of heading down to SPACs. But I'm excited to welcome Paul Swegle here tonight. Paul is a colleague of mine. He's an attorney as well. I feel lucky to know him because he's a wealth of information and a mentor to other startup lawyers and general counsel here in the region. He draws from a large experience both as working with the regulators at the SEC and as general counsel to a number of companies here, including companies that he's taken on different journeys and different paths of exit. So he always seems to be easily the highest energy attorney I know that dabbles in just about everything, and most recently has written a couple of books and is now advising and speaking at law schools on startup law and financing. So I'm thrilled to have him here to give us some more insight onto the SPACs venue and take some questions and answers throughout the presentation at the end. Please use the chat box for your questions, and I'll try to weave it into the presentation. And if time allows it, I'll see if I can unmute you and you can ask the question yourself. And please stay after. At about 6 o'clock, Minnie will do her magic and send us into breakout rooms where we'll have board members facilitating some time for networking conversations, an opportunity to introduce yourself and talk a little bit about the presentation. So one more thing, we at TiE Seattle have a lot going on this year. So there's been a lot of interesting communications going out, so stay tuned for it. We're gonna have a networking social next week on March 31st. We have a couple of RCMs that are here online today, including Karan Khanna and Pradeep Singh and Sona Vaish. I don't think she's on yet. We'll be facilitating tables and allow for some social networking at that time. And we're gonna be having a general meeting of where we invite several angel investors in town called the Angel Forces that drive our region here on April 27th. So keep a lookout for those opportunities to get involved and sign up with us here at TiE Seattle. So Minnie, our executive director, thank you for helping pull all of this together. And I'm going to turn it over to Paul to take it from here. Thanks, Paul.
Thank you very much, Madhu. And hello, everyone. It is an honor to be speaking with you. I've been a fan of TiE Seattle for a long time, so it's great to be here. I was asked to give this talk because, among maybe other things, I have been through a SPAC from the inside of a target company, what I consider a very successful SPAC that has closed. I am not going to mention the name of that company, and I do so many things that it's potentially hard for most of you to figure out who I'm talking about. You know, I'm general counsel of 4 companies. I'm in-house senior corporate counsel in another company. I am at a law firm where I have probably 12 startup clients. So I do keep pretty busy, but yes, I did find myself in the SPAC world, and I thought it was a lot of fun. I have a background with the Securities and Exchange Commission, so I thought it was, you know, sort of particularly interesting to go through this process from the inside perspective. I don't really consider myself a huge SPAC expert, but I certainly understand the process. And as a former SEC Corp Fin regulator and enforcement regulator, I understand the regulatory environment. So I think it's one of the more interesting topics, and I'm sure there's others on this conference who have additional information, different information, perhaps better information. So if you have other things to chime in about, or if you just have questions, feel free to chime in at any time. Maybe send a note to Minnie, and we'll field questions, or if they can unmute you, you can just ask the questions. So. As Madhu said, I have written a couple of books recently, and one of the things that I'm doing is I'm speaking a lot at law schools and MBA schools and undergraduate business programs pretty much every week. I spoke this morning to a a startup group called Cruise Entrepreneurship Center at Memphis University Business School today. And I do think that this book is being adopted by law schools and MBA schools and undergraduate business programs. It's about 600 pages, and it kind of covers everything about startup law and fundraising from beginning to end. And there are about 51 interesting little anecdotes. I call case studies in there to keep it interesting. It is targeted at law schools and MBA schools, but it is also written for founders. And so it's a fairly easy read. You don't need to read all 600 pages to get a lot out of it. But I think you're, as angel investors, I think the founders, would get a lot out of it. So what is a SPAC? What is a special purpose acquisition company? Probably, most basically, it's a blank check initial public offering that is, and maybe this is kind of a wrinkle folks don't know. It's exempt from a rule called Rule 419. Now, when I was at the SEC in enforcement in the late 80s and early 90s, blank check was a pretty bad term, and it there were good blank check companies, no doubt, but they were often fairly shady, and oftentimes they were used in pump and dump schemes and manipulations. So SPACs do have, from my view as a former regulator, kind of an interesting background. I just, we always had concern about them, that they could be used, and sort of any shell company sitting around, you could back into it with, supposedly an operating company. And back then it was frequently oil and gas companies, and they just were a bit fraught. There was a lot of question marks over blank check companies. After I left, I believe, as they adopted this Rule 419. And so 419 essentially says that any blank check company that has tangible net assets less than $5 million cannot trade until a target has been identified. And so that's a big distinction. People call SPACs blank check companies, and I think of them that way too. I think of them as shell companies. I think of them as backdoor IPOs. There's a lot of different ways to think of them. But essentially what happens now is sponsors will get together and they will file a SPAC IPO with the SEC. And they do this on Form S-1. So it's a full registration statement. But there's no operating company. So it is definitely lighter disclosure than a typical IPO. The SPACs raise, somewhere between, at the low end, 200 million to 500 million, maybe on average, but there have been many SPACs in the billions. And so I think it really is a function of the industry. If you're trying to launch rockets, what have you, it's going to be at the larger end. If you're in a less capital intensive sector, maybe they're going to be in the 300 million, 400 million range, which I think is a common number now. But after the SPAC and the sponsors raise this initial war chest to go out and find a target, then they have to go out and look and do their due diligence. And they have a couple of years to do this. They take that IPO money and they put the vast majority of it into trust, and they can't touch it. And interestingly, the sponsors can't even pay themselves during this period. So they are pretty much incented to find a target company. When they find a target, they go through kind of a long merger negotiation and due diligence, and then they merge with the target company. The target company becomes, through a reverse triangular merger, generally, I think, the public company. And then during this process of due diligence and negotiating a merger agreement, the sponsor and the target company will decide whether or not they want to raise more money through what's called a PIPE, which is a private investment in public equity. And so they'll raise hundreds of millions more depending on the business model and the objectives. But another wrinkle about the target is that acquisition needs to essentially cost, the fair market value of the acquisition has to be in excess of 80% of the funds in the SPAC's trust. So they are huge and growing. And now some of you know that the SEC issued an inquiry letter yesterday. And I kind of joked online that, on Twitter, I said, well, I've seen these inquiry letters and different things. And, hopefully it just leads to some rulemaking. And then a former fairly high up officer at the SEC said, well, that was an enforcement inquiry letter, to which I then replied, oh, well, you know, I guess they're going to regulate through enforcement inquiries, which, you know, we've seen before, rather than rulemaking. And then he kind of chimed in that he sort of agreed that hopefully they had some specific concerns to be sending out these inquiries. I think it's a bit of a fishing expedition. I think for the most part that the sponsors and the investment banks and the lawyers and the accounting firms and the other experts who are working on these large SPACs, I think largely, by and large, they are doing their best to comply with SEC rules and regulations. I think it's the phenomenon that has caught the SEC's attention. There have been some losses. There have been some SPACs that didn't work out, but I was a little bit surprised. Many of you probably were that, you know, there's this inquiry letter going out, a bit of a fishing expedition, but that's the SEC's job. And I'm not going to second guess them. I worked there for 8 years. I've seen these kinds of things go on. I was general counsel of a company called ShareBuilder, online brokerage, for 12 years. We sold that twice, so that was entertaining. But the SEC during that era sent out inquiry letters because all the brokerages were doing these marketing arrangements and white labeling arrangements and you know, all kinds of things with banks and credit unions. And ShareBuilder had one with Costco. We had one with you know, a whole bunch. We had hundreds of them. And then so the SEC did a very similar process, and essentially nothing came of it. So it's possible that the SEC inquiry will end the same way, but perhaps there will be some rulemaking. I have no idea what what vacuum they see in the current rules around disclosure and filings, because I'll discuss, there's a lot of filings. These are very expensive deals. This is not fly by the seat of your pants stuff that you can just kind of, you know, do with a few friends and, you know, launch a SPAC. It's a highly regulated process. So I'll be interested to see what they come up with, but they won't come up with anything probably for at least 12 months. So 64 billion raised in 2020, 200 IPOs. 2021, which some are calling the year of the SPAC, we'll see now at the SEC's splash of cold water, but 180 SPAC IPOs have already been filed in the first few months of the year, totaling $54 billion. And so I think we're on a record pace, and I'm not sure anything the SEC is saying is going to slow this down. And it's across all sectors and industries. It really did. There have been some flyers in esports and online gaming, electric vehicles, driverless vehicle technology, pharma. I think it's just any company that is looking for capital is going to be a target. And I think these are driven largely, as I think is covered by maybe a slide or two down, they're driven largely by sponsors who have particular interests in particular sectors. And they're seeing this as an opportunity to take that expertise and that interest and do a SPAC and go look for a company to acquire. So I'm going to look at a little bit from the perspective of targets and investors and the sponsors now. The target perspective, I think, is fairly obvious: cash. Now, I've been through it. It's an easier process than an IPO. If you're a company that's operating and looking for capital and thinking about an IPO, if someone comes along that has 200 million plus 300 million in the bank and says, "Hey, we're a SPAC and we're interested in talking," that's a very compelling call to get. And the sponsor's time frame is governed, as I said, by this 2-year limitation. So, you know, sponsors know that these SPACs have to get a deal done. If they don't get a deal done, all this effort is wasted because they have to return the funds in the trust back to the investors. So these are pretty motivated, sponsors when they give a call. It seems to me also that in reading the experiences of others, that valuation seems to be an easier discussion with SPACs. I think the sponsors don't have maybe as much stake in nickel and diming valuation down, perhaps the way underwriters might do. I think that the underwriters may have a sharper pencil on valuation than SPAC sponsors. because SPAC sponsors just want to get something done. They may have, 20% of the deal at the end of the day. So they really just want to get a deal done. So the nice thing too, from a target perspective, is, if a sophisticated sponsor team calls you up and they know the process, boy, you've heard the phrase, many hands make light work. When a SPAC sponsor team calls you that's, sophisticated and well-funded and ready to go, the lawyers on the other side are, brilliant. The accounting firms that are around these processes are great. There's money to burn to get the deal done, and the team and the lawyers and the accountants know the drill. So a lot of the uncertainty is removed. There's a treasure chest, war chest to get this done. There's a short time frame, and there's a sophisticated team that's called you up and said they want to do this. And there's also very strong investor interest. So that also removes some of the uncertainty. Whether or not the SEC's letter will have an impact on that, I don't know, but I sort of suspect not. Due diligence on formality, and the formality of due diligence is a little bit less. So a SPAC will have underwriters during its IPO. But once the IPO is done, the underwriters really don't have that much of a role. I don't think they're anywhere to be found in most deals once the thing is public, because the SPAC team has their own experts, their own lawyers, and so the lawyers for the SPAC and SPACs also have their own governance structure. So even though it's not an operating company, it's a button-down corporate structure with a board, with senior officers. These senior officers aren't getting paid, as I mentioned, but they have a big incentive to get this done. And so they do have an incentive to do great due diligence. And my experience was due diligence was excellent, but I can imagine that an underwriter, underwriters counsel are notoriously difficult. I don't know if anyone's underwriters counsel on this call, so sorry for the insult, but underwriters counsel, extraordinarily difficult. SPAC, counsel, maybe not so bad, but still very diligent. And so there's another thing that target officers will have in mind, and that's the ability to get liquidity faster. So if you don't have underwriters involved anymore, you don't have a lockup. And so that's kind of a very interesting wrinkle. So if you have a target company, a bunch of officers have been working on their company for 7 or 8 years, that's kind of an appealing thing. There's no 180-day, 6-month lockup required. It can be imposed, but it's not, there's no underwriter to impose it. And so I don't know how common it is, but it's certainly not 100% of the time that there's a lockup on selling after the merger. But if others have insights, anecdotes about how often they see lockups, that would be brilliant, because that's kind of, almost kind of insider secret information a little bit. I don't know that it's published. And perhaps it must be, actually, because that would be of interest to investors. How long are insiders locked up? So I didn't do any research on it, but in my experience, there's not always a lockup. The SEC review for a Form S-4 is generally also a little less severe than a Form S-1. So if you have the same operating company doing a Form S-1 versus the same operating company merging with a SPAC on a Form S-4, the SEC review of that registration statement may not be as severe. When I was at the SEC, I felt a little bit surprised that, we really, really scrubbed down the S-1s super hard, and we scrubbed down the S-4s pretty hard, but not as hard. And I think that's because when you have an S-4 registration statement, that is a merger registration statement, and it's also a proxy statement. You have a lot of sophisticated players on both sides. You have operating businesses, maybe with longer financial histories. It just seems that S-4 reviews are a little less severe. And there may be some on the call who take exception to that and say they were drubbed pretty hard by the SEC on their Form S4. But in my experience, a Form S1 review is a little more severe than a Form S4. So that's another advantage for targets. In terms of timing, if you're filing an S4, you're not probably going to think there's going to be 5 sets of, amendments filed with the SEC in response to comments. You might have 1 or 2 sets of comments that you have to amend the S4 for. But all that said, the cost of doing a SPAC and then closing the merger with a target is very expensive. We're talking very expensive, $1 million plus or more, I would think, all in on average. So maybe less than an IPO, but not hugely less. It's not a completely different league of expense.
Hey, Paul.
Yeah, question.
Before you move on, there's a couple of questions relevant to what you're
Please.
speaking about.
And I'll back
One
up then.
question is, coming from the audience, shouldn't the target company be the one who's actually ready to be a public company, like already has the right profile, growth trajectory? Otherwise, would they risk choppiness in the quarters or years ahead?
So I'm going to touch on that a little bit later regarding due
Hold on that one.
diligence. So you can imagine that sponsors are concerned that the SPAC target be reasonably ready. I think what actually happens is that they are reasonably ready on average, but not super ready. They don't have audited financials, right? So that's a huge hurdle. Generally speaking, they're not going to have audited financials. They're not going to have public company controls in place, and so the idea is really to throw a ton of money and expertise at it. And again, I got to kind of keep, I can't really go into detail what I experienced, but I can say there were, as many or more experts and firms working on the process as you could possibly imagine. Multiple accounting firms looking at different things. And so it's not that there's probably less work done to get the company ready, but that it is really compacted into a time frame. And that can be a real strain on the target company team. And they may need to ramp up and hire quickly and fill positions in accounting and finance and legal. And but there's so much money available to throw at it, and you realize there's kind of a huge war chest after the fact. I think what you see in most SPACs is that the target is ready to get ready. That's probably what it is. They're ready to get ready if there's a lot of resources. And I think that's what's going on. And that might be one of the areas of risk that, with SPACs that the SEC is concerned about, is that not every target probably was IPO ready, maybe for another couple of years. I think the revenue opportunity needs to be there. The market opportunity needs to be there, but it's a huge infusion of capital. All of a sudden, a company that maybe had, 60 million bucks in the bank knows it's going to have 800 million or 500 million in the bank after the merger. And so, as I say frequently to clients in talks, money solves a lot of problems. That's a lot of money to solve a lot of problems. And I think, the experts surrounding this whole SPAC frenzy, I know they're working overtime and they're developing a massive amount of expertise. And so that is kind of an interesting nuance of this, is that big accounting firms are doing a lot of these deals and they're throwing a lot of resources at it. And, just the monthly bills, to be ramping up are well over, $500,000, for this company that wasn't spending $500,000 a month. All of a sudden you're spending $500,000, or you're accruing costs of $800,000 a month with these experts. So long-winded way of saying that, yeah, the targets, the sponsors are concerned about the targets on day one of the IPO. When you have NewCo after the merger, there's a little flexibility, but you've got to be ready to be a publicly traded company. There's a little flexibility on when you get all the controls in place. There's about a year where you have some ramp up, but you're going to be filing 10Ks and Qs and 8Ks right off the bat. So, any other questions?
Yeah, just I think 2 more that would make sense here before you go. And
Sure.
a typical IPO, The cost to the of the a company is 6 to 7% of the underwriting fee. What is there that same cost in a SPAC situation?
You know, the costs are sort of spread out, interestingly, and they are negotiated.
Okay.
So the initial IPO, the target has nothing to do with those costs. Those costs are borne by the sponsor team. They're, the IPO underwriters take their fees. I looked at a couple of S4s and S1s today just to kind of see what the underwriters were getting and so forth. B of A is involved in a lot of these deals and they're getting large fees. But unlike an IPO, the target company is not paying all these fees. They're coming out of this huge war chest. Then at the same time, you're probably doing a pipe, so you're bringing in more money. So I don't know on average what the percentage cost all in that's allocated to the target. But given that it's split between these two entities that operate very independently right up until the instant of a merger, I think that again, like many hands make light work. Different buckets of money make for maybe less expense.
Yeah.
But I don't have as much insight to how those things get negotiated. I know that sometimes expenses, like you're going to have to pick up this expense, or they're going to have to pick up that expense. I think there's a little horse trading that goes on between the sponsor and the target.
One last question, which might actually be part of your next part of your presentation, so feel free to weave it in if that makes more sense, is how is this process different from a reverse merger from the perspective of an investor in the company prior to the SPAC?
That is a good question. So that's like a typical S4. So, right, I think what the question there relates to is, and maybe I have it wrong, but with just a typical merger where maybe a smaller companies merging, or smaller publicly traded companies merging with a larger company perhaps, and um, that goes through a Form S4 registration statement, and the smaller company shareholders have to vote to approve this transaction, where they're going to be kind of the smaller fish in the bigger pie or the bigger pond. Um, One thing I would say is there might be more money in this process, and there might be more experts around this process because it's so fast and so dynamic, and it's kind of a machine. It's a bit of a machine, whereas a merger is sort of a one-off thing, and parties come together. They have investment bankers advising them what to do. But I suspect there are not as many players on average watching a huge merger and dealing with a huge merger. And you also don't have these simultaneous filings that we're going to talk about. So there's going to be more cost in a SPAC, I suspect, all around, but there's more money available. There's fresh money coming in simultaneously, which you don't always see, right. In a merger, you could have a financing in connection with a merger. Certainly there's just all kinds of different structures that could happen. So I think it's a little bit apples and oranges, but you know at the end of the day, the Form S4 will discuss and describe the merger in detail. There's going to need to be pro forma financial statements of what the thing would look like, just like in a merger. What if these companies were together for the last 3 years? What do those pro forma financials look like, and so forth? So it's the same scrub down of the disclosure to investors that you have in an S4. I think the dynamics are just different because it's just a different beast. You have different motivations, you have different teams. Um, the sponsors probably in most cases become directors of the new co. And that may be the same thing in most mergers, but maybe not all mergers. There may be a complete change of the guard. I think that's about all I can say, knowledgeably about the differences between a typical reverse triangular merger and sort of the same concept that happens in the context of a SPAC. I think it's just there's a lot more money maybe flying around on average, and there's a lot more filings that need to be done. And yeah, and
Understood.
it's a little bit more of a purposeful hunt for a target, maybe, right? So Does anyone else have anything to, any other experiences that they want to share that they think are a little bit different in that regard compared to a SPAC? A typical merger versus SPAC. Does anyone have any experiences that led to the question?
Well, the clarifying the question was like some of these, including Brianna here with Karetsu, they
Mhm.
have portfolio companies, and if they're an investor in a portfolio company, just trying to understand what the benefit to that investor would be, or the impact to the investor, um, if one of their companies decides to go this route.
Well, if one of their portfolio companies is approached to go through a SPAC, um, you know, my personal observation would be, hey, that's probably a pretty good deal if you like the sponsor team. And that may be one of the fundamental questions. What do you think of the team that is going to be a 20% or greater owner of this entity after the fact? Do you want to be, joined at the hip with them? Do you want them to be on the board? Do you want them to be in the governance structure after the fact? And how much money do you need? Would you rather do an IPO and be the masters of your own fate, right? And take that risk that you're not going to get an IPO done, or take that risk you're not going to get just a typical exit done? Or with this SPAC with a giant war chest, you have to assess the sponsor team. And I think that probably comes down to the number one question. Do you like the sponsor team? Do you think they're smart enough to help you run the business after the fact so you'll be successful? Or somehow are they setting you up for some sort of failure, that you'd rather avoid and stay in charge of everything and do an IPO? That's a big maybe difference between a SPAC and a regular IPO. With an IPO, you're sort of in charge, to the extent the market lets you be in charge. If you have a successful IPO, think back to some of the big, successful IPOs, Google, Facebook, others, would they have done a SPAC, or would they rather be? And I can imagine Zuckerberg like, no, I'm not doing a SPAC. I'm going to end up in this IPO with 23% interest. Why would I do a SPAC and let these people come in I don't like, tell me how to run my business? So that's probably a real dynamic. If you're struggling for cash, the IPO path is unclear. The SPAC thing is a blessing come true. But if you're killing it and you're on track for an IPO and you want to stay in charge and not have any dilution on your cap table, that would be the other set of factors.
Please go ahead. I think some of the other questions will be answered.
Okay. Yeah,
Otherwise, I'll
sure.
bring them back up here soon.
Yeah, sure. So investor perspectives, just quickly. So the kind of and I'm kind of someone who believes that Main Street investors, deserve a break and should get in IPOs a little bit more. I was at ShareBuilder for 12 years, and we tried to make it more accessible to our investors. Yeah, sure. Some of them are going to lose their money. They're not all going to lose their money. We got tons of Main Street investors into Facebook. They made a killing, right? We had a ton of mainstream investors into Google. They made a killing. And so I've always had that view that, boy, Wall Street is a little unfair to Main Street investors. They say it's to protect them, but really they are kind of a gatekeeper. And this whole process has taken away the gate. And it's done so because these IPOs go public at $10, and they probably trade within a $10 range, 10, 12, 9, 8, 10, 11. And so investors, before there's a target identified, before there's a merger, there's this huge long opportunity to get into these IPO shares. And so as someone who believes in democratizing investing, a certain amount, I think this is a great thing. And investors, mainstream investors, probably do too. You can see at the very near the bottom, Goldman Sachs has said that SPACs have underperformed the broader market by 24%. I suspect that's probably true, and investors have to be careful what they invest in. But that is probably, from an investor perspective, that's the most interesting thing about SPACs, is now mainstream investors can get in on these IPOs and just hope that the sponsors have a good business plan, good objective, and that they're good at finding a target and negotiating a deal. The other thing that's interesting is that SPACs go public oftentimes with units that are a combination of common stock and a warrant, or a portion of a warrant, maybe 50% of a warrant, which is a right to buy more stock at a fixed price. These warrants oftentimes cannot be exercised until 30 days after the merger, and then not longer than a year. And then if the price trades at a certain price, trades above a certain price for a period of time, the company might be able to force a redemption of the warrants and say you have a few days or a week or 2 weeks to exercise your warrants, or we're going to buy them all back for a penny each. So that's kind of a very interesting wrinkle about SPACs that's a bit different. The other thing that's different for investors is that they can back out up to the time of the merger through redemption, meaning that they can say, I want out, and they get some amount close to the $10, but minus the original purchase price, the original IPO price, minus some expenses and so forth. So I'm not going to get the whole $10 back, but it's entirely different than a typical IPO where, you can't just put get your money back. And also they can sell during that period. So they can do a redemption, or they can just sell on the market. Now, if the price wafts down to $8 in the market, then the redemption probably looks better for a period of time. The other thing for investors is that they do get interest. They get interest accrues in the trust account that holds the SPAC's IPO proceeds, and so they do get the some amount of interest, but it's not the same as being in the stock market, and that money can sit there for 2 years, depending on how long it takes to either find a target or liquidate the SPAC. So those are kind of some interesting investor perspectives. Any questions on that, or should I plow ahead and talk about SPAC sponsors?
I think there's one relevant question about
Good.
from Pradeep. He's suggesting the Zuckerberg example would imply that SPACs are riskier for the incoming investor than a straight up IPO. Could that be the partial explanation for this Goldman Sachs data that SPACs have underperformed in the market?
I think that's sort of out of the bounds of my expertise, not being an investment banker.
Okay, no
I
problem.
think
Another
that
question.
I think frankly, as an investor, I feel like, I could make as good a decision about a SPAC investment as I could an IPO, right? Because they can both go well, or they can both go terribly. And so I think it's a facts and circumstances case. What's the company that's thinking about doing an IPO? What's the, say you're tracking a SPAC and they announce a target. If you read through the S4 and you like the business model and you like what the SPAC sponsor team is saying about it, you like what the management team is saying about it, I think you have sort of an equal chance of knocking it out of the park or taking a bath relative to the same analysis for an IPO. But again, I'm not an investment banker. Someone might disagree with that.
Based on that, is there like, based on kind of your experiences, you may or may not be able to speak to this, but maybe just as a trend, is there an ideal or recommended company size that makes for a good target for a SPAC?
No, I think it's sector specific, right?
Okay.
I think it's really sector specific. Some sectors require massive amounts of capital, and others require less capital. They just want to take over more of a market, right? But if you're building huge manufacturing facilities to launch, electric vehicle company or a self-driving vehicle, technology, that could be very capital intensive. So I don't know that there's any way of looking at a SPAC and saying, I want to be in this range. Now, over time, it could bear out that at one end of the range or the other, the rewards are bigger. But some of the hugest SPACs, I think, have been the most successful, right? So I don't know if that being more well funded is the issue, or just that the investment opportunity was bigger because the space was a more attractive opportunity. Some investments, some sectors are very revolutionary and they cost billions of dollars of investment. But if all of a sudden you're able to put satellites, you're able to launch rockets, the rewards are in the billions and plus. So I think it's hard to say that there's any range or size of SPAC that is most appealing. There's some resources I'll point to at the end. And one of them, yeah, I think it's called SpacInsider.com. And so if you want to get knowledgeable about SPACs and read what they're saying about them and read some of the S4s and S1s, that SPAC Insider is pretty interesting. They are posting, there were multiple filings today. So there's filings every day. And so you can really read about what's going on and sort of try and get a sense of the market. That's one thing I really haven't done, is try and figure that out. And I think it's a very good question, because frankly, I'd like to invest in some SPACs.
I'd,
So
I'd like to, I think this is a kind of a follow-on question to that. Hey, Pradeep, I'm going to turn on your, unmute you and see if you can ask your question directly.
Thanks, Madhu.
Yeah.
What I'm really getting at is I'm trying to understand what's the structure of a SPAC before they acquire it. Is there some principles to go out and start a company and they have discounted ownership in the SPAC? The, the way the SPAC makes money isn't clear to me.
that is a good question. So this slide sort of covers that a bit. So SPAC sponsors are a little bit all over the place, but they tend to be well-known investors, private equity investors, money managers, venture capitalists. You have serial entrepreneurs getting into the game in connection with well-known investors and money managers, private equity investors. And then you also have others who have really strong expertise in a particular sector getting involved. And my understanding of what they do right up front, I think that these sponsors get their stock very inexpensively. And the way things are structured, they end up owning about 20% of the post-merger company. And so I think the interests are pretty well aligned, looking at it, as a bit of an outsider, that they get a 20% interest for kind of doing the following things: putting together a team, forming a company, kind of a dream team company to go hunt down a target. They pay for lawyers and accountants to file a Form S1 registration statement. They coordinate with an investment banker to make sure that IPO is, launched successfully. And so then they go on this 2-year, I think it was like a hunt. They're going hunting for a target company. Now I've read that oftentimes they kind of have some ideas who they're going to approach, and they may have approached them in advance, but that would become a huge disclosure issue. So I can't speak knowledgeably to that, but you certainly couldn't be SPAC sponsors, have in the back of your mind that who you're going after and that you're going to consummate a deal with them because you've talked to them and you have a handshake, and not disclose that. That would strike me as securities fraud. So they really have to go on this hunt. They may have some idea who the targets are, but from the outside, it looks like a bit of hard work. It looks like every bit as challenging as what investment bankers do, and probably with more risk, because again, the SPAC sponsors, the managers of the SPAC, cannot take a salary. So they get nothing for, up to 2 years. And then there's a risk they don't consummate a merger. There's a liquidation and they get nothing in the liquidation, right? So they're really going at risk over a long period of time, and they are rewarded with that 20% or greater post-merger interest in the new co. They will also have warrants. So that's why I say potentially greater than the 20%. They're going to have warrants. They're going to probably make a killing on the warrants. The warrants, right? They don't have to pay for them unless they're in the money. And so that's, has the, probably the feel of free money when you're in that situation and the stock price is way up. So, I think that's just it. The sponsor's motivation is having a 20% interest in a company that merged with a SPAC and is publicly trading, and they've helped position the management team and the operating company for success. So that's really, I think that's their compensation. Then they end up on the board and they may get some more equity. They may get a small stipend for being on the board, but I'm not sure how often they become managers, I think what they do is they start over again. They start another SPAC. There's a lot of serial SPAC sponsors. That is a game that is going on. So they're probably not taking a significant, work opportunity with the operating company ever. They have one or two members on the board, but I don't know. I think that's the whole answer. It's 20% ownership after the merger.
Paul, just to follow up on this. So switching the perspective to that of the CEO or the founding team, are you saying that instead of paying 5-7% to an underwriter, to an investment banker, I'm paying 20% of these guys? I don't think you are, because I think what you're saying is to get that 20%, they have to give the founding team money to buy that 20% stake.
Yeah, it's a little different than that too. The other thing that's difficult, maybe, and it's one of the next slides. It's coming up in a couple slides. You have to realize that there's a negotiation that goes on, and it will be different in every case. The SPAC has a pile of cash in a trust, and they have the ability to do a PIPE. The company may or may not have a pile of cash, but it has a business opportunity. And so in the merger negotiations, the value of the respective pile of cash versus the operating business's opportunity, say if it was to do an IPO, what would its opportunity look like? Well, this is very similar. So it's kind of a pro forma opportunity. Well, with this cash, we could do all these things. So we want to have, we want the existing operating company company shareholders to have 60% versus 40%, or it could be vice versa, 40% versus 60%. So that 20%, it's probably subject to negotiation. It has to do with this valuation. It has to do with what they're bringing to the table. And I don't think it's a fixed percentage. But again, they're bringing a lot of cash to the table, right?
To just translate that mathematically, does that mean that they buy their 20% usually at a discount on what they expect the first trades to be?
Well, they get that.
What's going on? How are they making money? I'm confused.
So the sponsors have a huge percentage of the SPAC. The SPAC is an IPO company. There are other people who have percentage of the SPAC that's publicly traded. The SPAC is a shell company that is publicly traded. It goes out and trades at $10. These SPAC sponsors have equity in that SPAC. That equity merges with the equity in the target company, and they get a milieu. They get whatever their percentage equals, and then they also have these warrant kickers. So then after the merger, if the stock trades up to 25 and they have a huge percent, 20% of the new co, they're going to make hundreds of millions of dollars.
I just want to give an example, Pradeep, to what Paul was saying. Like if you look at Chamath's company, Social Capital, the sponsors bought pre-merger 20% shares at 0.002, right? Whereas rest of the 80% investors like you and I bought at $10.
Right.
So I guess that's how they made the money.
Right.
As from a founder perspective, you gave a massive discount.
Yeah.
Instead of paying 5-7%, you gave 20% of the goddamn equity.
Yeah.
At like 1% of the price.
Like all startup founders, they're getting their stock pretty much for free, par value. And they're contributing capital. They're contributing their sweat equity. They're contributing an idea, a SPAC idea in this case.
No, be careful. As soon as you say they're contributing capital.
Well, I meant they're contributing human capital.
Access to capital.
They're contributing human capital. They're contributing their idea, their sweat equity, their go get itness, get her done. They go out and get her done. That's the sweat equity, the human capital they're contributing. Yeah, but they're not paying much for their shares. But as I said, they're long at risk for 2 years in many cases. And there have been a bunch of, at least 100 SPACs over the years. And I don't know the exact number, but I know it's at least 100 that liquidated. And so that means they got nothing.
Yeah.
Right. I think when it liquidates, that's a bad outcome. So I think it's kind of interesting that the whole SPAC thing is made in America, for better or for worse. I kind of like it. Other markets are playing catch up. And as I said, the whole thing evolved from slightly sketchy beginnings, but I consider what's going on right now, fairly impressive from the perspective of, the degree of sophistication that is brought to these deals, the caliber of the individuals involved and their experience. I don't have anything negative to say about it, but others who look more deeply at it might see, as in all situations, you have real experts and real go-getters, and then you probably have posers riding the coattails of these other SPACs. There could be a lot of posers hiding in there, putting investors at risk. So the process is driven by and framed by some very sophisticated SEC filings. As I said, the SPAC has to do an IPO to get that war chest, and that's a Form S-1 registration statement. No picnic to get that through, but when you don't have an operating company and operating financial statements, it's going to be easier for sure. Then you have this Form S-4 merger proxy and joint registration statement. Then if the teams decide they want to do a PIPE, you're going to have another Form S-1 registration statement. And that might be more significant because that'll be filed at a time when the disclosures are out there about the target. And that won't go effective until simultaneously with the merger. And then right after the merger, you've got to do within days a Super 8K. We'll talk about that in a second. So that's a huge filing with the SEC, very difficult, very complex, a lot of financial complexity to it. And then you're immediately a publicly reporting company filing 10Ks, 10Qs, got to do your proxy statements. You got to be doing Section 16 insider sales reports on Forms 3, 4 when sales are allowed. And then you've got a bunch of folks at the operating company that were under a previous equity compensation plan that has converted into and been adopted by the new co. And all of those shares and issuances need to be registered on a Form S-8 equity plan registration statement with the SEC. So it's a very SEC intensive process. Any questions about that at all? So while the SPAC sponsors and the target company are negotiating the merger agreement, there's a huge due diligence that goes on. So you have multiple work streams going on at the same time. It is very complex. It's very, it's kind of stressful. And as we have said before, you're taking a company that doesn't have all the internal processes, procedures, and audits to be a publicly traded company. So you're simultaneously negotiating a merger agreement, assuming it's going to go through. So you have to do all that work and spend all that money, assuming it's going to go through, and you're doing a full audit all at the same time. It's a pretty exciting process, I think, for most target companies. You're just really under the microscope, and you may have 5 or 6 or 7 firms simultaneously working with the target company to get everything ready to do due diligence. And you're also negotiating this thing at the same time. The merger negotiations involve all kinds of things, as any merger negotiation does. What are the financial terms, the valuation, what's ultimately the merger ratio going to be between the SPAC company and the operating company? And you're negotiating, should we do a PIPE? How much should we raise? And what are the terms? Are there going to be warrants? That is all part of a negotiation. And who's going to control the board, governance issues? That's all going to be negotiated. Management composition. Are people going to stick around and stay through this? Who's going to be the senior team at the new co? And so once the merger agreement is signed, that triggers the Form S-4 registration statement, and then you're off to the races. So you think you've been working pretty hard, and then you're off to the races. You've got to immediately sell this thing you got to file this complicated S-4 registration statement, which you've been working on simultaneously with a negotiation. And then you have to, the sponsor and the target go on these road shows and analyst meetings, and they're beginning to solicit proxies. You're working with an investor relations firm, and the target management team will meet with the SPAC major investors, the institutional investors, and you're really trying to limit redemptions. You're trying to get them enthused about the merger. And so it's a big roadshow and advertising effort, promotion effort to promote the merger and keep all the current investors in and bring them in into the pipe and not have them, come in and redeem. The SPAC shareholders have to make some decisions too. They have to vote on the merger. So these are the folks who bought in the IPO or bought in the aftermarket of the SPAC, the acquisition, the company looking for a target. And so they have to review the proxy statement and try and figure out, are they going to vote for the merger or not? Or are they going to, file, seek redemption, or are they going to sell in the market? And if they don't do either of those things, sell or redeem, then they have to figure out at some point when and whether they want to exercise their warrants before any mandatory redemption. After the merger closes, so what happens there is the merger agreement has been signed. Then there's a fairly short period of time where a special meeting is called and the SPAC shareholders vote to approve the merger. If it's approved, then the deal closes. And when the deal closes, then the next day, the stock ticker will change from the SPAC's ticker to a new ticker, which will probably look fairly similar. And then that same day, there's a brand new board of directors. So there was a board on one day, and then the next day there's a new board of directors. And then within a couple of days, there has to be a form Super 8K filed. An 8K, as all of you I'm sure know, is called a current report at the SEC. If your auditors leave, you're going to file an 8K. If you have an acquisition, you announce, you file an 8K. If your CFO leaves, you file an 8K. So it's called a current report. There has to be a description of the property, a description of the business, description, of all the risk factors, and then a huge amount of financial information. 3 years of audited financials, selected financial data, management's discussion analysis, and some other quantitative and qualitative disclosures. So that Super 8K is quite a push. So in summary, a SPAC is a blank check IPO exempt from SEC Rule 419. It is almost certainly faster and more certain of an outcome for a target than an IPO, but still very expensive and not guaranteed. The audit could raise problems. The merger negotiations could be bad and kind of go south, and there could be a lot of wasted money and effort, leaving maybe a target that was already struggling financially more struggling. I'm not sure how often that happens, but everything that can happen does seem to happen. Well-known successful serial SPAC sponsors are particularly hot in the sector. Mainstream investors can do well and can get in IPOs, but they can also suffer losses. And obviously the SEC is concerned about that. A key driver of speed and nimbleness is the absence of an underwriter after the initial IPO. Another is that the original IPO is done and there's a huge war chest and sort of a, reduced, uncertainty about completing the deal. The process is dominated by highly sophisticated SEC filings and related financial disclosures, including audited financials and pro forma financials. So it's a huge lift for everyone at the table. The cost is a little less, I suspect, than IPOs, but still in the millions for complicated deals. And some people think it's a fad, but obviously SPACs have been around for a while. They've evolved. They started a little bit shadier, maybe, for sure, I think. But I think they've now evolved into pretty highly sophisticated proposals. And I think that they'll continue to improve in their disclosure and execution. And I think maybe that SEC, inquiry could have the effect of weeding out, posers and focusing the market on better deals. Here are some references, and maybe you can just screen capture this. If you type any of these in, you'll come up with some great resources. From all kinds of different perspectives, including the SEC right there, smack dab in the middle, what you need to know about SPACs. So screen capture that and type those things in. I think that SPAC Insider at the very bottom is quite interesting. This article over here, a primer on special purpose acquisition companies, I mistyped it. It's not 2016, it's 2006. So it was a very sophisticated early view of SPACs, and I found it very interesting. This Harvard law form on corporate governance from 2018 is also very detailed. So a lot of these have a lot of detail that I wasn't able to cover. Are there any questions? We're at 6:02. I think I landed this bird right on time.
Thank you. That was wonderful. I do want to ask one question and one more comment, and then we can go into the breakout rooms if you're open to it. Who is typically involved in a PIPE? Is it also private equity and VCs, or What types of players are in that?
So a PIPE is a private offering in public equity, right? It's kind of a strange beast, and it's big money. So you're probably going to the big institutional SPAC investors. So SPACs have huge investors. So in these IPOs, people take big positions in them. And then those are the folks who are probably filling out the pipe, or by then the company has been doing some road shows, trying to courting investors, privately, probably under Rule 506B, right? This is a private investment. It's an exempt, offering. But then what's interesting, what I guess I kind of don't understand about, it's a private investment in public equity, but then in the end, so I get it now, you file a Form S-1 and it's not an original issuance registration statement, it's a secondary sale. So you do the private investment and then you have to file this Form S-1. It's a resale registration statement for the investors. And that has to be filed, within days of closing. So, but those PIPE investors are big, that's big institutional money, generally speaking.
We have Craig Sherman on the call.
Craig Sherman. So he's probably been listening and silently mocking me, as he is probably far more expert in the area of SPAC. So Craig, correct anything you heard or expand on anything you heard.
No, I'm not mocking at all. Paul, I think his presentation was excellent and right on point. I think you're, and maybe I'm a little bit more cynical about this, and
most people are more cynical than me.
Well, cynical about SPACs in general, because when we were talking about the economics, and Pradeep was asking, hey, what's in it for the sponsors? The sponsors are getting a bunch of their equity in this company for free, and yes, they're taking some risk in that they're not receiving a salary until a deal gets done, but they're putting in relatively little capital, and they have huge upside where they're really misaligned with everybody else involved once a transaction closes. Because if they successfully acquire a company, and the acquisition is always priced at $10 a share, because that's just how SPAC deals work, and the deal closes and 6 months later the lockup expires so people can start trading in the stock. The sponsors may have a 1-year lockup instead of a 6-month lockup, but let's say a year later the stock is trading at $5 a share. Well, for the investors who invested in the SPAC at $10 a share, they're pretty unhappy. They lost half their investment. For the sponsors, stocks trading at $5 a share, they made $4.99 a share. So there is a lot of upside, and I think that's why you're seeing this lunacy right now of a massive number of SPACs being created. And I think my favorite banker joke was in the Wall Street Journal a couple weeks ago, where a Wall Street banker said, I know more people who have SPACs than have COVID. And a semi-disturbing joke, but it's kind of true. I mean, we have in our law firm, we have I think about 10 SPAC deals that have been announced in the last 6 weeks, and we have more than 50 that are at some stage of the process, mostly at the early stage of the process. So there's this crazy disconnect between valuations of deals that get done through a SPAC, or at least there has been for the last few months, and deals that do an IPO the old-fashioned way.
So I think that is those are excellent observations. And, when we look at venture capital firms and how they're structured and how they're incented, and they've got this 2% management fee, whether or not they succeed or fail, I just think in finance, you're always going to have disconnected incentives. Sometimes you're going to have perverse incentives, counter incentives. I think your points are valid, but, being sort of the glass half full person here, I'm seeing a certain amount of value creation too that wouldn't have happened. I mean, the value is being created. Companies are being funded that would have struggled before because of, these Wall Street gatekeepers. And the gate's been kicked open a little bit by these maybe dangerous incentives. And you probably feel like it's, prudent that the SEC is sending these inquiry letters. And I can't really disagree. I think, more light on anything is better. But, I'm not ready to throw it all out and say it's all bad because there's bad incentives. I think target companies have to be smart, investors have to be smart, the SEC has to be on their game. But I'm frankly kind of happy to see this infusion of financial activity. We were languishing with poor IPO numbers the last 10 years, and now we're kind of back a bit. We've got huge infusions of capital and innovation going on. So I think when there's always good and bad kind of match each other and sort of cancel each other out a little bit, but hopefully in this case, the good is much better than, these incentives that you're talking about where people are making a lot of money off of, stock they paid pennies for.
Yeah. But no, I agree with that, Paul. I worry a little bit about the pendulum swing because I think, you look at where this country was 22 years ago, in the late 90s, when everybody was going public. And in the last, I think it's actually more than 10 years, you look back over the last 20 years and the number of public companies in the US has fallen by about 2/3. And so I think we've had this pendulum swing away from companies wanting to be public. Now we're having this massive pendulum swing back in a very short period of time towards everybody becoming public, whether they're ready for it or not.
Yeah.
And,
yeah.
and I do worry about the correction, the inevitable correction that will follow.
Yeah, one thing that I thought was interesting in the materials I reviewed for this in preparing for the talk was that one article from 2006. There were some big SPAC numbers in, I think, 04, 05, 06, 07, and then we had the crash and then it all dried up. But this thing was starting to happen then, and it's kind of come roaring back. So it's not like this came out of the blue. SPACs were kind of on a tear in the early 2000s, interestingly. I didn't know that. I mean, exactly like the ones we're seeing now, I think, for the most part.
Well, I think the big difference now is the quality of the companies that are willing to do SPACs.
Yeah.
I will tell you that I sat in board meetings in September, October, and boards would just kind of laugh about SPACs and say, oh, those are for garbage companies. Not literally garbage companies, or maybe in a few cases, literally garbage companies, but low quality companies.
Mm-hmm.
And those exact same boards are now saying, go, we got this big opportunity here, let's get the deal done. And I think that the quality companies have never really been interested in SPACs. I think even in 2006, when there was an increase in activity, I think it was still low quality companies that would look at the possibility of a SPAC. And now we're seeing very high quality companies that would be doing a traditional IPO, maybe not as soon as they're currently looking at doing a de-SPAC deal, but companies that are legitimate businesses with substantial revenue are doing SPAC deals.
Interesting. Well, I'm glad that you provided those perspectives that I was not able to provide. That was very insightful. I was hoping that you were going to be here and provide some of that.
Thank you,
So thank you,
guys.
Craig.
Thank you for chiming in, Craig. This has been great to hear both of you. Lots of interesting stuff. So stay tuned. We'll probably, hopefully maybe do some follow-up in this space.